everyone, this is Kathy Lean with BK Forex. I'm here with my colleague Boris Schlotzberg, and we're very excited to share with you our Ajax indicator. It's a cool new way to trade news that helps us identify only the highest probability trading setups. What the Ajax indicator does is it hopes to achieve an 80% plus accuracy in trading major event risk, such as the non-farm payrolls report, the ECB rate decision, Australian employment, UK PMI services, and the list goes on and on. Now, what's really great about the Ajax indicator is that it's designed for both short-term traders who want to be in a trade for no more than 20 minutes to an hour, as well as medium-term traders who want to ride a bigger move and don't mind holding a position and trailing their stops for 24 hours, 48 hours, sometimes even longer. Now, before we begin, I'd like to talk a little bit about, why did we design this Ajax indicator? Well, for those of you that know us, you know that we are experts at trading news, and we're always looking for opportunities to trade news on both the short and medium-term basis, because we recognize that news moves currencies. And oftentimes, some of the biggest opportunities in FX trading come from trading news, either on a short or medium-term basis. A great example was the April non-farm payrolls report, where we had a very tight consolidation in the Eurodollar before the release. And when the non-farm payrolls report came out, to an explosion of volatility that led to quite a bit of opportunity in the hours that followed. Now, the Eurodollar is always a lot more jagged in terms of its price action and reaction to non-farm payrolls, but when you have something like the dollar yen, the reaction tends to be much more orderly. Another example of news moving currencies on a more consistent basis are the central bank meetings. For example, we had the April central bank meeting from the ECB, and the European Central Bank was much more dovish than the market had anticipated. And so that led to not only an immediate sell-off in the Eurodollar, but it actually led to a sell-off that lasted, for an hour or so afterwards, and actually lasted for another 48 hours afterwards. Now, these two event risks only led to relatively short-lived price action, but there can be cases where we have a major piece of data or a major shift in monetary policy stance, and that can set off a new trend in currencies. But in the case of the Ajax indicator, what we focus on is shorter term moves, and we should focus on the intraday day trading opportunities. So we focus on the opportunity that this chart kind of presents to us, and in this very scenario, this is one of those opportunities that we could have banked profits in the ECB rate decision. And in one of our later videos on how to trade economic data, we actually show you the back tests and results of some of the key economic reports. But back to the U.S. non-farm payrolls report. Even in this U.S. non-farm payrolls report, there could have been some nice trading opportunities on a short-term basis, because as you can see, there was initial, rally, and then followed by sell-off, retracement, followed by a deeper sell-off. So once again, that presents itself as a possible trading opportunity. Now, many traders recognize the opportunity that news releases create or provide us, but they're very hesitant about trading news, and they find trading news very difficult. And the reason for that is because, rightfully so, spreads tend to widen when news releases are scheduled to be out. And so if you're trading a short-term trading strategy and the spread widens, and sometimes it crosses, they can widen as much as 10, 15, maybe even 20 points depending on your broker, that you can be stopped out or triggered into a trade even before the data is released. It can also lead to very fast price action where you're in and out and stopped out at a blink of an eye, and you feel like you have no control over the position. And that's obviously due to a significant amount of volatility, because news releases can cause all of this crazy price action that makes traders potentially second guess their positions. Now, to solve this problem, we spent months developing a new news trading algorithm. And this news trading algorithm mitigates a lot of the risks that we just talked about. And the algorithm or indicator is called the Ajax indicator. Now, You may wonder, what is Ajax? Why do we name this indicator Ajax? Well, Ajax is actually a poker term meaning aces jacks, which is one of the best starting hands that you can have. And just like Ajax in cards, what the Ajax does in the Forex is it puts probabilities on your side and helps you to become a winner. So what does the Ajax indicator do? Well, first and foremost, it finds the optimal time to sell rallies and buy dips after the market reacts to an important news event. It does not trade in front of news or even after it, allowing it to sidestep the volatility and slippage that typically surrounds news trading strategies. And this is really key because this is the biggest danger that a lot of traders face when they're trading news. It also does not take a directional bias. In other words, it does not interpret the news and can therefore take advantage of both positive and negative reactions to the news equally well. It uses tight risk control parameters with trades generally lasting no more than 20 minutes to an hour. In back testing, we found that when it comes to trading news, we're using the Ajax indicator as proven to be accurate more than 80% of the time. So the whole idea is that it's designed to extract small but consistent profits from the Forex market while minimizing risk and exposure to volatility. And the average Ajax trade lasts between 20 minutes to an hour. Now, the Ajax indicator rules may seem a bit complex, but before I get into it, I want to kind of ease your concerns and say that we are showing you the Ajax indicator rules, but we've also included, completely free as a part of this course, the MT4 EA Expert Advisor for the Ajax. So you can follow. You can take a look at the bonus video, follow the instructions there to install the EA into your MT4, and just allow it to spit you out a signal when there is actually a trade. So that kind of takes a lot of the complexity out. It makes it really easy to use the Ajax indicator. But even with that in mind, we think that it's extremely, extremely important to understand, what is in this EA and how the indicator works to begin with, so that you can understand why these signals are being generated. So there are three basic guidelines to trading the Ajax indicator that is true irrespective of whether it's a long trade or a short trade or one of the variations that we'll show you afterwards. First and foremost, all Ajax orders expire 4 hours and 15 minutes after the news event. So if a news event comes out at 8:30 a.m. New York time, that means that at 12:45 New York time, the order is canceled. All open trades, regardless of whether it is at a loss or in profit, should be closed by 4 p.m. New York time, because this is not the type of setup where you want to carry it through into the Asia trading session when there could be some crazy volatility. And all of the Ajax setups are traded on 5-minute charts. So basic guidelines: orders expire 4 hours 15 minutes after the news event. All trades close by 4 p.m. New York time. We're using 5-minute charts for the setup. So we're going to start by looking at a long trade. The first rule of the long trade, and before I go into this, the Ajax indicator simply involves the price chart and the RSI. And the RSI is the relative strength index. And the whole idea behind the relative strength index on its most fundamental basis is that if the RSI is greater than 70, it's considered overbought. If it's lower than 30, it's considered oversold. Now, that's not the way we use the RSI, but that's how relative strength index works on its most fundamental level. Now, in terms of our Ajax indicator, the first rule is that for a long trade, we want to look for RSI to move into overbought territory, move in above 70, but be no higher than 80. And we're looking for this to happen within the first 15 minutes after the news event is released. But just because the RSI moves above 70 does not mean that we take a trade. Instead, we wait. And this is really the key to news trading in general, as well as the key to trading the Ajax indicator, which is that patience really pays off. So what you want to do is you want to wait and to look for the RSI to drop back below 64. So you want to see the RSI within the first 15 minutes of the release go above 70. Then you want to look for the RSI to drop back below 64. And when it drops back below 64, you still don't take a trade. You then want to wait for it to rise back above 64. So imagine what's happening right now. In that scenario, first you have the data come out, and obviously the currency pair is rallying quite significantly. RSI goes all above 70. And then there's always the natural retrace. And when the retrace happens, the RSI is pulling back a little, it drops below 64. And then when it regains its momentum and RSI rises back above 64, that's when you want to buy. The money management rules are the following. You have a 10 pip target, a 20 pip stop. Now, it is negative risk reward, but in the next slide, we'll show you some results that should explain why, even though it's negative risk reward, you end up being net positive and you still end up achieving 80 to 90% accuracy because this strategy is so efficient. But you need the larger 20 pip stop in order to avoid any even short-lived retrace. So as I said earlier, the Ajax aims to achieve 80% accuracy. And these are some of the results that we've had with the Ajax strategy. This first graph is of non-farm payrolls. And you can see that in this example here, we have a good number of samples. Basically with non-farm payrolls, we have 28 samples and we have 21 trades, 19 of which gave us 10 pips of profit, and only 2 of which gave us 20 pips of losses, achieving an accuracy of 90% and obviously generating quite a bit of pippage. Now, it may not seem like a large amount of individual profit, but because of its consistency, you can also vary the position size that you use. And we do have a video dedicated on proper position sizing. The Australian employment report numbers are very much similar. In the Australian employment report, we took a look at 2 years worth of data. We have 27 samples, and in the 27 samples, we have 19 trades, and 16 out of those 19 trades were profitable, giving us an accuracy rate of 84%. And this is the type of short-term trading strategy that you really want to look for, and the type of high probability setup that you want to look for. And then in this last one, in UK PMI services, we've dug up a year worth of data, and you can see that over this period, we had 16 samples. Some of them were 0 trades, and later on we'll explain to you in what situations we get a 0 trade. And so of these 16 samples, we have 10 trades, 9 of which were profitable, giving us an accuracy rate of 90%.